All of these ETFs that I'm going to go over in this video have consistently beaten the returns of the S&P 500, and these are all great. The S&P 500 is widely considered the benchmark for investing because one can fairly accurately expect about 10% average appreciation yearly by investing in this fund long term. But if you're able to get 12% or 14% instead of that 10%, that's absolutely massive. For example, if you invest $1,000 per month for 15 years and receive 10% appreciation per year, you'd expect to have $345,447. If you invest the same amount, $1,000 per month for 15 years, and receive 14%, you could expect $533,246, which is a difference of almost $200,000 for doing absolutely nothing except picking funds with higher appreciation. Now, over this past year in 2023, VOO, or the S&P 500, went absolutely hard in the paint and finished up over 23%. But like I said, all of these in this video have actually beaten VOO, or the S&P 500, on a total return basis, or absolutely crushed that dividend of the S&P 500, so you're going to be able to get cash flow that absolutely crushes that of VOO. When I see funds that are absolutely crushing it, I definitely want to research further and try to figure out which one of those to throw into my investing portfolio to supercharge it. But what I'm not trying to do is say, okay, this one's beating the S&P 500, so I'm just going to knock the S&P 500 out and not invest in it. I always invest in the S&P 500 or the total stock market index, something that's just a broad, solid ETF that's been around forever and something that you can consistently rely on. So even with a pretty considerable amount of fund overlap, I still think there's some solid reasons as to why you should have these types of funds in with the S&P 500. But for now, let's go over the 7 ETFs that are absolutely crushing the S&P 500. My name is Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. Okay, so number 1 is probably the one with the most amount of hype, especially today, because technology has been absolutely crushing it lately. This one is a growth ETF, which means that it's just one that focuses on investing in fast expanding and often more volatile companies in hopes of realizing above average returns. Growth funds have been a big portion of tech, healthcare, and other exciting industries that should shoot off to the moon. VGT is the Vanguard Information Technology ETF, and over the past 10 years, it's had an average yearly appreciation of almost 20% per year. This year alone, it's up over 49%, and it's just on fire. VGT has solid companies like Apple, Microsoft, Nvidia, Broadcom, Adobe, Cisco, and Oracle. Among other things, it's heavily invested in semiconductor technology, system software and technology hardware, and then all kinds of application software. VGT seeks to track the investment performance of the MSCI US Investable Market Information Technology 2550 Index, an index of stocks of large, medium-sized, and small US companies in the information technology sector. Something very interesting about this ETF, though, is that it actually doesn't hold some huge names in the technology sector that you would think that it probably should be holding, namely Google, Amazon, and Meta. Since this fund only holds companies designated information technology, and these three are not classified as such. Google and Meta are communication services, while Amazon is consumer discretionary. So for those of you with this fund as your only tech ETF or your only growth ETF, are definitely missing out on some huge names. The other con of an ETF like this is that it's basically a specialty sector ETF, and that specialty sector is information technology. So if for some reason information technology as a whole just decided to plummet, then this in your investment would definitely go down. This just makes this investment a bit more risky and a bit more reliant on that one sector. The expense ratio for VGT is 0.10%, which isn't very high at all. The total number of stocks within this ETF is 315, and the PE ratio is 32.9 times. Now that is a pretty high PE ratio, but as you'll see in a lot of these ETFs, the higher PE ratio is kind of justified, and that's kind of normal in any growth ETF, even though all of these aren't going to be growth ETFs. The next ETF is very similar to VGT, but it definitely doesn't get nearly as much attention as VGT gets in the technology sector, though this one is actually better in the pure technology space, in my opinion. XLK is the Technology Select Sector SPDR fund, and this fund is on fire. XLK is actually even beating VGT over the past year and has appreciated over 52%, which is just insane. The Technology Select Sector Index seeks to provide an effective representation of the technology sector of the S&P 500 index. XLK has an expense ratio of 0.10%. It has 64 total holdings, so much less than VGT, but then has a lower PE ratio too at only 27.17 times, which is more favorable as well. The 10-year average appreciation is close to 20% as well. Let's stop for a second so I can actually highlight how crazy this actually is. From our example from before, the S&P 500's average of 10% brought us about $345,000 over 15 years. If one were to invest the same amount, $1,000 per month for 15 years in a fund like XLK that got about 20% appreciation, one could expect almost $900,000. You'd only invest $181,000 of your own money, and then the fund would make you a free and extra almost $700,000. Crazy. The top holdings in XLK are overwhelmingly Microsoft and Apple, but then also Broadcom, Nvidia, Adobe, Salesforce, and Advanced Micro Devices. The fund is made up of all technology but huge in software, also very heavy in semiconductors, and then also hardware, storage, and peripherals. This ETF is consistently very strong, so definitely add this to your list to research in January. The next one on this list is another technology ETF, and I promise that not all of these are tech ETFs, but tech has been absolutely crushing it lately, so I definitely had to add a couple of my favorites. FTEC is the Fidelity MSCI Information Technology Index ETF, and it's been up similar to the other first two at over 49% over the past year. FTEC follows the MSCI USA IMI Information Technology 2550 Index, which is a modified market capitalization weighted index that captures the large, mid, and small cap segments of the USA market. All securities in the index are classified in the information technology sector. So this one's great because it's going to have companies that are also mid-size and small, which is much different than what you're going to find in the S&P 500, since that's all large cap, only large companies. So those looking to diversify a little bit, this is a pretty good option. Over the life of the fund, so since 2013, over 10 years, it's consistently brought an average appreciation of over 18%. Its holdings are very similar to the other ones, which is no surprise, with Apple, Microsoft, Nvidia, Broadcom, and Adobe rounding out the top 5. This fund holds 315 companies and has an expense ratio of about 0.08%, so it's a bit cheaper in that regard than the first two on this list. The PE ratio is 29.53 and has a perfect 5-star rating from Morningstar. The next fund I'm incredibly high on, and I actually talk about this a lot on my channel, so you've probably heard this before, but I wanted to highlight it because number one, it's an amazing fund, but number two, there's a lot of confusion about this specific one. Most of you know and probably already investing in the Invesco QQQ ETF, but even more amazing is the new fund from Invesco called QQQM. These two funds are almost identical. They both track the NASDAQ 100, they both hold basically 100 companies. The biggest difference is the fee, which I'll go over in a second. They both have nearly identical performance. The dividend yield of QQQM is 0.70%, where QQQ is only 0.65%. One of the few differences between these two funds is their expense ratio. The newer QQQM has a lower expense ratio by 0.05%. QQQM has an expense ratio of 0.15% compared to QQQ expense ratio of 0.20%. QQQM is a better option if you want to pay the lowest fees possible, since its expense ratio is 25% smaller than QQQ. QQQM crushed it at over 51% this last year. It has a 10-year of almost 18%. The top holdings are Apple, Microsoft, Amazon, Broadcom, Meta, Nvidia, and Tesla. The reason why I really wanted to highlight this one specifically is because the first three ETFs that I first went over all were just purely technology-only ETFs. Whereas this one is a broad growth fund, which means it does have a lot of technology, but also has a bunch of other sectors as well. This makes it a bit less risky and definitely more diversified than the other ones. QQQM has a lot of information technology, but also sectors like communication services, then also consumer discretionary and consumer staples, and then also healthcare. QQQM is one of the largest holdings in my entire portfolio. This next ETF on the list is very interesting for a couple of reasons. Warren Buffett is one of the best investors ever, and his biggest concept revolves around sustainable competitive advantage. He picks companies that have such a big competitive advantage that it would be very, very hard for another company to try to compete in that space. He's been so successful due to this strategy alone. Now, a company that has a huge competitive advantage is kind of like a castle that builds a huge moat around it so that if enemies try to come capture the castle, it's going to be hard for them to even reach it. The next ETF is strategically called MOAT, M-O-A-T, and it puts a focus on US companies Morningstar believes possesses sustainable competitive advantage, or moats. This ETF is the VanEck Morningstar Wide Moat ETF. It does have the highest expense ratio at 0.46%. I like this one a lot, but I really like its corporate responsibility in the type of companies that it's picking for the fund. It's trying very hard to promote ethical business practice, which I can definitely align with. The companies it invests in must have a low ESG risk. They must have very low controversy scores. A company's carbon risk can't be too high, and the companies here are not involved in tobacco, controversial weapons, or thermal coal. The top 10 holdings are much different than the ETFs so far, with ones like Intercontinental Exchange Inc., Allegion, Autodesk, Google, Theradyne, and CME Group rounding out the top 6. Since inception about 10 years ago, MOAT has appreciated about 12.83% each year on average. The sectors for MOAT are pretty evenly balanced, with information technology, financials, healthcare, industrials, and consumer staples as the biggest ones. Very interesting ETF for sure, and definitely low fund overlap with what you're probably already investing in. The next one is called SPY-D, and it's all the good about the S&P 500, but has an incredible, super high dividend yield. This fund is the SPDR Portfolio S&P 500 High Dividend ETF, and it has a low expense ratio of just 0.07%. The index is designed to measure the performance of the top 80 high dividend yielding companies within the S&P 500 index. Like I said, this dividend yield is incredibly high at 4.58%, which blows the S&P 500 VOO dividend yield of 1.48% out of the water. SPY-D has an incredibly low PE ratio at only 13.7, which is very attractive for value investors. Since inception in 2015, the fund has had an average rate of return of about 7.5%, which isn't incredibly high, but with that dividend in there, it really adds up. The top holdings in this one are going to be different than probably what you're invested in already as well, so this is another good one to diversify. Top holdings are Seagate Technology Holdings, NRG Energy Inc., Amgen Inc., Phillips 66, and KeyCorp. The sector breakdown is nice and balanced with high financials, real estate, and utilities for some nice safety and strong cash flow. And now this last one is one that I'm probably the most high on in the dividend space. Now, to be clear, the biggest holding in my entire portfolio is the S&P 500 because it's amazing, it has history that can't be beat, and it's here to stay. But the second biggest holding is this dividend ETF. Mostly because when you buy it, not only does the compound interest and price appreciation work in your favor long term, but also that dividend continues to grow. It has history of growing its dividend every single year, and not just growing it, absolutely crushing it with growth. So you're buying a dividend now that costs just a little bit here And then later on, it's going to be worth so much more, not just the price of the entire ETF, so you're making profit there, but also the dividend will have grown. This ETF is SCHD, and in this video, I go over all the ins and outs about why it's my top dividend ETF and the best dividend ETF that I've ever found, and why you need to consider it for your portfolio today.